Good evening and a warm welcome, everybody. I am Angelica Kinney, your host for the webinar today, and let's dive straight into it. Today's webinar is all about mastering asset allocation with index funds. And to understand this better, it is my pleasure to introduce Mr. Hardaman Seth. Mr. Hardaman Seth is head of sales from ETF business at Nippon Mutual Fund based out of its corporate office. He has been with Nippon Mutual Fund for the last 18 years and has essayed various roles across big geographies. Sir has a total of over 27 years of rich experience in the mutual fund industry in the financial services space, including ETFs, banks, and distribution. Sir brings both expertise and practical insights to the table for the webinar today with a wealth of knowledge and expertise. Before moving ahead with the session, please know that if you have any questions, please send them in the comment box and we would take those up towards the end of the session. Sir, over to you.
Thank you very much, Angelica, for that generous introduction and warm welcome. Good evening, all of you, and a very warm welcome to this webinar. As Angelica pointed out, the topic for today's discussion is asset allocation via index funds, and how I have divided this presentation is basically first talking about what index funds are and how typically these index funds work, what has been the kind of the market size of these index funds, and typically how index funds help in the asset diversification in terms of managing your assets better. So I hope this presentation that you can see is live. So what you see on this presentation is four gentlemen who really don't need any introduction. Out of these, three people that you see, barring the gentleman on the extreme right top, all these three gentlemen, Charles Schwab, Charlie Munger, and Warren Buffett, all of these people have made enormous wealth by active management of funds. They're the ones who have been our guideposts for so many years. These are the kind of people who have made enormous wealth by selecting stocks at different intervals, by selecting sectors at different points in time, as well as by by guiding us, when to enter, when to exit, etc. But look at what these investors themselves have done of their wealth. For example, Charles Schwab says most of the mutual fund investments I have done are index funds. Approximately 3/4 of his investments are in index funds. Or for that matter, Charlie Munger says why 95% can't beat the S&P 500. So basically, he's also talking about index. And same thoughts have been echoed by Warren Buffett. But there's one gentleman on the right top who is Jack Bogle, who is also called as the father of index investing. He is the one who has made similar wealth by investing into passive funds. So why I wanted to start with this slide is just to give you a perspective that active and passive investing is coexisting worldwide. It will coexist in India, and no one strategy can outplay the other. That's what the crux of this slide is. Before we begin any further, let us first understand what are index funds. Well, I think it's slightly distorted. Sorry for this. It was pretty much okay once I made it. Anyways, so index funds are typically, all index funds, as the name suggests, they are constructed to track an index. Now, typically, all of the index funds are open-ended. They are well diversified. They could be taking care of various asset classes like equity, debt, commodity, international funds, etc. But what is most important is that the performance tracking of these index funds is subject to the underlying index. There is no fund manager involved in managing these funds. Therefore, it lends a very high degree of transparency because at any given point in time, you would know that if you are investing into an index fund, the index fund in turn is investing into the underlying index that is the given mandate. So it cannot change. It cannot change for the life of the fund. No matter what kind of market situation is, whether markets are in bear phase or in bull phase, that condition cannot change. Unlike in an active, where a fund manager is there managing a fund for many years, but all of a sudden he decided to leave, right? Such kind of thing cannot happen in an index fund. Further advantages, there are a lot of choices today in index funds, and in fact, if you see, go to the SEBI website and see, and you look at what are the new launches that are being planned, you'll be surprised to see that out of every 10 new launches that are being planned on the mutual fund side, at least 8 would be on the passive fund side. So that's the kind of concentration of new launches that are getting filed with SEBI. So therefore, as an investor, you have plenty of choice to choose from. And there are various categories, a few of which we are going to discuss in the later slides. Also very, very important for an index fund is that it eliminates the non-systematic risk. Now, what is a non-systematic risk? Basically, any risk that emanates once a fund manager makes a selection about the stock or a sector. Since every index fund is backed by an index, and as I just said, this mandate cannot change for the entire life of the fund. Therefore, this kind of a non-systematic risk is not there in the index fund or a passive fund. One of the things that a passive investor. So let me put things in perspective. There are two kinds of investing. One is active investing, one is passive investing. The basic difference between the two, as we just saw, is in active investing, there is a fund manager that is involved. In a passive investing, there is no fund manager involved. There is only a dealer who invests the money that they receive exactly as per the mandate of the index. So that is the essential difference between an active and a passive fund. Now, passive funds, within passive funds, there are two categories in which you can invest. You can invest either through index funds or you can invest through ETFs, which is exchange traded funds. Now, one of the disadvantages of investing in passive through ETFs is that an investor needs to have a demat account. That is mandatory. While if you are investing into an index fund, you do not require a demat account. Also, if you are a regular mutual fund investor, the index fund investing is exactly same as the mutual fund investing. You need to invest. There are cutoff times. You need to invest before the cutoff times to get the day and NAV. And the redemption also, there is a cutoff time, and you need to redeem before the cutoff time to get your funds on a T+1 or a T+2 basis, depending on the asset class you have chosen for investment. So it is very, very simple to invest. It is as simple as investing into a normal mutual fund. And finally, I think what also plays in favor of index funds is that there are so many fund managers who are working to discover that alpha or to discover that one or two stocks that are going to be the next, going to be the value providers, for example, right? Now, once those stocks are discovered, what index has to do is index has to just take those stocks in that index, depending on the mandate, and invest. So there's also a benefit of market wisdom that a passive investor gets at a very, very low cost. Now, these are various type of index funds that are currently available in India. So broad-based index funds, thematic, oblique sector, smart beta, commodity, which is in the shape of fund of funds, and debt. Out of this, we'll see in the subsequent slides that broad-based index funds are one of the largest, but very strongly and closely picking up with these broad-based index funds are the smart beta funds, which again is one of the categories which is becoming very, very popular these days. And there is a lot of net inflow that is coming into this category of smart beta funds. Obviously, commodity in India currently is restricted. Commodity investing through mutual fund is restricted to gold and silver. But this is also one of the areas where an investor can see Other commodities also getting approved, subject to SEBI's approvals. But things are underway, and it is expected that more commodities will find its way into the mutual fund space. Currently, it is restricted to only gold and silver. Finally, debt. There are a lot of debt funds available on the index fund platform. Most importantly, being the ones which target a specific maturity. So, bulk of the debt funds on the index fund side are target maturity funds, which come with very high credit. So there is no problem on the credit side, because most of the papers that are used in these debt funds are either government of India securities or state development loans. So therefore, credit is pristine. The tenor might change. So they offer you tenors, starting from 2 years, 5 years, 10 years, 15 years, even higher. So that's the entire plethora of index funds that are currently available. Now, we just take a very simple example to show you what index funds are. Now, on the left chart, you see a Nifty Bank Index, right? Now, this is the index, which is a Nifty index, which is available for us to see on the exchange or on the NSE website. And on the left, you see the kind of weightage and the kind of stocks that are there in that index. Now, if there was an index fund that were to be made out of this index, you will find something like this on the right. You find exactly same names in the index with exactly the same proportion, right? So that is the objective of an index fund. It has to mirror the index completely. However, in practical world, this might not always happen. Of course, the stocks will be chosen exactly as per the mandate, but the weights might vary, and that is, there could be some difference, which we call as a tracking error, which is basically the difference of the return of the index and the return of the underlying index fund. So in practicality, that difference can arise while we are talking about index funds. And therefore, at times you might also feel that to differentiate how good two index funds are, it is always advisable to also look at, because largely all index funds have similar performance. Because they are mirroring the underlying index, so their performance will be more or less similar. But what will make a difference is the fund, which fund is better than the two. The comparison will also entail you to look at the difference in the tracking error of the two funds. So the fund with a lower tracking error is a better fund to invest in rather than the fund with a higher tracking error. So as I said in the beginning, we very strongly feel that both active investing and passive investing have their merits. As I said, active investing is where there is a fund manager involved. He comes with his own set of expertise. He has been, he is supposed to be in the market for many, many years. He has that, wisdom of selecting stocks, either top down or bottoms up approach. And he will also take proactive calls in buying stocks or selling stocks which are not performing. In contrast, you will have passive investing, which obviously come at a lower fees because there is no fund management fee involved here. They are not biased in that sense. If any sector currently looks good or bad, index fund cannot take the call of exiting or entering that sector because it has to clearly mirror the index. And it is, all the index funds are very, very transparent. So if you want to look at the portfolio of any index fund, please go into the NSE website and look at the portfolio of the underlying index. That will be the portfolio of the underlying index fund as well. Now, we'll see why we need to invest in index funds, and we'll talk about a few use cases of index funds. It's an interesting slide I've put here. There's some myths around passives. First myth and the most common is that there is no value addition, right? The reality is that there is a huge value addition happens because, as I also mentioned in the first slide, there is a plethora of choices of funds from you to choose from. And today, if I were to give you an example, most of the fund houses that have launched both active and passive funds, you will see that their passive fund choice or the number of funds on the passive side is almost same or even more than the funds that they have on the active side, right? So there is a huge choice to be made. And if you just recall the slide that we were on, which told you about the categories of various index funds, you will find that today index funds are available across the spectrum. So whether it is broad based, whether it is thematic, whether it is sectoral, smart beta, debt, commodity, etc. So it gives a huge choice for investors to look and invest into these kind of funds. Another very important myth is there is no alpha in passive. We agree there is no alpha. There is not supposed to be any alpha because an index fund is supposed to hug the underlying index, right? But you have a specialized segment of passive funds which is called as smart beta. And very briefly, I'll tell you what smart beta is. If beta is considered as the whole market, then smart beta is something which tries to generate a return which is higher than the benchmark. Smart beta itself will become a whole topic to be discussed. So I'll not be talking in too much detail about smart beta, but suffice to say that smart beta funds typically tend to outperform their indices. And that is how, without even the presence of any fund manager, but basis only on the underlying index and the quants, it outperforms the underlying index. And the last myth is passive is boring. Somebody said an investment has to be as boring as possible. And why it is said is that, you should do an investment and you should forget about it and let it grow. It's like, you are planting a sapling and every day you wake up and you see how much that sapling has grown. You just need to nourish it and the sapling will grow into a big tree over a period of time. So everything like investment, the nature has its own rules. So it takes time. So passive is boring, but we feel that it is anything but boring. You have choice of products, you have choice of asset classes to move in. Plus, at the same time, you just keep it where it is. You just continue to see that you are very well diversified, and that's about it. You don't even need to be too much worried about the performance of these funds, because over a period of time, all of these funds will come up and try to deliver as per the investors' expectations. Well, I'm sorry, this again, graph has got overlapped. So basically, what we have tried to show you here is that what are the challenges in active investing. Never mind the overlap. What is important is the number here. So in all, there are more than 21,000 intermediaries, financial intermediaries, which includes mutual funds, which includes brokers, which includes life insurers, registered AIFs, PMS, etc., 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 etc. Now, all of these put together are all working on a simple premise, is to create an alpha in the investments that they are doing. Now, if you look at the the graph on the left hand side in your pie chart, you will see that top 100 stocks account for almost 60% of the total market capitalization, and top 50 stocks account for almost half of the market capitalization. So it is becoming exceedingly difficult for these 21,000 intermediaries to find alpha in these stocks, because everybody is chasing to find alpha in this space itself. So therefore, this is where passive investings come to the rescue. Wherein, as I said in the previous slide, the passive investing will help to pick up the stocks that have been identified here, and basis on the mandate, they will continue to be a part of the future indices. So you as an investor will get exposure to those stocks, and at a fraction of a cost. So all of the wisdom of these 21,000 people you are getting at a least possible cost. William Sharp is also, most of you will know about this gentleman. So he says that active investing is basically zero sum game. So there are fund managers, there are research analysts, etc., working on identifying stocks, and typically all the returns that you get from the portfolios, some portfolio managers will deliver very high returns, some portfolio managers will, within the same portfolio, might not deliver high returns, might deliver negative returns. So at the end of the day, it is a zero sum game. And when you are accessing the market, it will the sum total of all the active portfolios will be equal to the market return. And out of this, we'll have to remove various costs. So those costs we have mentioned here, those could be, a management fee, custody fee, commissions, the market impact cost, which comes from bid and ask spread, difference in bid and ask spreads. So therefore, what you're finally getting is the market returns minus all of these expenses. Therefore, in index funds, we know that there is no management fee, right? And other expenses are lower. So therefore, typically an index fund will tend or will outperform the active funds in various scenarios, which is what is also shown in this scorecard, which is called as a SPIVA scorecard. Now, this is a Standard and Poor and active versus active, right? So this basically tells you, now this is a Standard and Poor's subsidiary. So what they do every year twice, they measure the performance of active fund managers vis-a-vis their underlying indices. Now, what you see in this chart is, now if you look at the June 2024 scorecard, what you will find is that in Indian equity large cap space, right, 86.67% of the fund managers were unable to beat the underlying index in a 5-year period. Here we're not talking about creation of alpha. We are talking about how many fund managers were unable to beat the index, the underlying index. So 86.67, which is a staggering number. And believe you me, these percentages are not higher only in India. SPIVA does this report for the entire world, including Europe, America, Latin America, and Japan, China, etc. All of where this percentage is upwards of 60 to 70%. So this is a phenomenon that is prevalent worldwide. However, if you look at mid and small cap, this percentage drops to 43%. What then, what clearly tells us is that in funds like, large cap funds, for example, Nifty 50, as we saw in the previous slide also, it is becoming very, very difficult to create an alpha because the space is very, very limited. And there are so many intermediaries who are trying to create alpha within that space. A fund manager's expertise or knowledge comes into fore while he's managing mid and small cap funds, which is where this percentage falls. And therefore, many of the mid and small cap fund managers are able to beat the underlying indices. Now, we have done 2 use cases for index funds. Now, what you see here is the performance of an NSE Nifty 50, which is a Nifty 50 index, which you see here is in black. And you see, the 4-5 consumption stocks that have been put here. Now, what it typically tends to say is that if you were invested, during the COVID period. Now, we have specifically taken the COVID period and the bounce back after the COVID period. Now, in the COVID period, most of the consumption stocks, which we have selected here. Now, as you can see here also, most of the consumption stocks had fallen, and post-COVID, they had started to rise. But at the same time, if you observe Nifty, Nifty, barring one stock which was ITC Limited, which again ended lower. Within most of these stocks, Nifty was performing better. So had you taken an exposure into individual each of these stocks independently, you would have generated a lower return, while Nifty itself, the standalone basis, delivered a far higher return. Another use case. For example, you have 10,000 rupees to invest. Now, I'm giving you a list of stocks here on the left, which I would request you to buy with that 10,000 rupees. Now, also given you is the price of one share, right? Now, this is the latest price, as of day before yesterday. Now, if you were to use this 10,000 rupees, what will you do? Either you will buy 2 shares of Siemens and you're done. You will not be able to buy even 1 share of Bajaj Holding because fractional shares are not allowed in India. ABB, you will be able to buy 1 share, Bosch nil, Lombard 5 shares, and Torrent Pharma 3 shares. Right? Now, let us look at what happens if you are investing into this 10,000 rupees into a index fund. And we are referring here to, because all of these stocks are next 50 stocks, so we are talking about a next 50 index. Now, look at the same cost here, but the weightage of each of these stocks in Nifty Next 50 Index. So therefore, with this 10,000 rupees, this is the percentage of each share you are getting in your portfolio. So you're getting almost 5% of Siemens, you're getting 4.2% of Torrent, even 0.45% of Bosch in your portfolio, which with 10,000 rupees, it wouldn't have been possible for you to take exposure to even 1 share of Bosch. So this is the true and the best benefit of investing via index funds. So today, I'm sure all of us would know that the most expensive price stock is MRF, right? Now today, again, if you were to look at buying MRF, you would need to have, even for 1 share, you would need to have, I'm not sure about the exact price, but I think it's about 1.5 lakh rupees. So you would need to have 1.5 lakh rupees to buy just 1 share of MRF. But through index funds, you will be able to buy at least a fraction of MRF in your portfolio, even with as small amount as a 10,000 rupees. So typically, depending on whether an investor is a regular investor or a low risk taking investor, or investor who is slightly advanced in terms of taking higher risk, or somebody who is expert, there are index funds that can be used in all the cases. For a regular investor or a low risk taking investor, in addition to the investments that he or she is doing, we recommend broad-based index funds. For example, Nifty 50 or Sensex 30 or Nifty Next 50, etc. For a medium risk taking investor, in addition to broad-based, we also recommend thematic or sector-based index funds and smart beta index funds. And somebody who has a high risk taking capability and is financially well versed, we advise that investor to look at any or all kind of index funds in their portfolio. We'll quickly talk about how passive funds, especially index funds, outlook in India. So overall, mutual fund market size in India is currently at about touching 70 lakh crores. Out of this, passive funds, which includes, as I said, ETFs and index funds, is now touching almost 11 lakh crores. Bulk of the AUM currently is in ETFs, 8.1 lakh crores, and rest is in index funds. What is more important is that total passive funds currently are 523, and if you look at the perspective, this is almost 1/3 of the total number of schemes available in the mutual fund space today. Similarly, if you were to look at how much are the passive folios, so passive folios are currently 3.84 crores, out of which index fund is 1.27 crores. Again, to put things in perspective, the total folios in the mutual fund space currently is about 21 crores. So this percentage is also close to about 17%. The overall AUM, if you were to see, is also currently close to 17%. Bulk of the this 11 lakh crores is in equity. 8.2 lakh crores. About 2 lakh crores is in debt, and 70,000 crores is in commodity, which is gold and silver. This was what I was just talking about. So if you look at this percentage here, 16.6%, this is the current passive share amongst the overall market share of the mutual funds in the country. And very important is that the passive share, which was a meager 1.5% in March 14, has today jumped to almost 17% as of January. So which is a huge jump. And now what our experience tells us, and if we were to also look at global markets, this trend is expected to only grow in the future. This is a further bifurcation of index funds. So almost 2.8 lakh crores. Again, the jump here has come in from March 2004, where it was almost negligible at 5 billion today, to jumping on to almost 2.8 billion rupees in Jan 2025. And these are the number of schemes. We are almost at about 300 schemes in passives, index funds. Net sales is a very important number that we use in mutual fund parlance, and this basically tells you what net inflow a mutual fund has received, net of redemptions. So if you see in the current financial year, mutual funds have already, the index funds have already clocked in almost 47,000 crores of net sales, and it continues to grow. In the entire last financial year, the total net inflows in index funds were only 23,500 crores. So we're almost now looking at a number double than what we did in the last year. Again, this is the category-wide net sales. So as I was talking about, the Nifty 50 index and Nifty 50 index, which are broad-based indices, right? And smart beta index. So Nifty 50 index has seen an inflow of almost 15,500 crores, while similar inflow has come into smart beta in this year. While in the last year, this number for smart beta was almost half of that of Nifty 50 index. Now, we will talk about the asset allocation and the asset classes. It's a very interesting slide. If you look here, what we have tried to show you here is that there are different asset classes that perform, in different periods of time. Now, for example, if you see let's talk about this year, 2024, the year gone by, sorry. So gold was the best performer in the year gone by. We were talking about the calendar year here. You had equity at 13.2% return, and debt was at number 3 with 8%. But where was gold in the year 2023? It was at number 2. Where was gold in 2022? It was again at number 1. So what we have seen here in this chart, what is coming out is that there is no single asset class that has remained on the top. Gold has remained on the top in 5 of the last 9 years, rather the last 10 years. Equity has remained top in the last, in 3 out of these 10 years, while debt has been a top performer of the 2 of the last 10 years. Again, we are not even suggesting that since gold has outperformed majority of times, it will continue to outperform. No. If we were to even bifurcate it into the 10 years prior to 2015, the things could look very, very different, right? So the idea of telling you or showing you this graph is only that no single asset class has or is expected to remain on top every year. This is further diversification. So if you look at within asset class, equity and debt returns, 2024 was the year of small cap, which generated the highest returns. So in fact, both 24 and 23 was the year which belonged to small cap, but 2022 it belonged to large cap. A small cap again made a comeback in 2020 and 2021, and wherein large caps dominated in 18 and 19. Again, similar stories unfolding here also. Similarly, if you look at debt, long-term debt has been an outperformer for the last 2 years, but it was short-term debt which was ruling the roost for 3 years, during COVID time. So be it top performers in equity, where large caps have been top performers in 3 years, but small cap been top performers for 5 years, or be it debt, where short-term debt has outperformed the long-term debt by 6 to 4 years. Every time we've seen that there is no single asset class, or within asset classes also there is a huge divergence. So what do we do? These are the challenges. Typically, there are fundamentals that are driving equity, and this could be very, very different from what you see in gold or what you see in debt. We as investors might not be able to clearly see where the valuations are and what is the right time to change. Even if that we want to do that change, if it comes at a cost of taxation, we will not be sure what to do, right? So therefore, what is the solution to this? The solution is, what we have done is we've just deep dive into the asset allocation model, and just to give you a broad idea of how you should look at asset allocation. So the asset allocation talks about 4 parameters that one needs to consider: your financial security, the age of the investor, the risk appetite, and the investment duration. Now, depending upon the grid that we have shown you, your investment choice will be, your asset allocation will be governed by that. Now, for example, let's take 2 extreme examples. Suppose you don't have too much of financial security. Age is not on your side, in the sense that you might have retired or you are close to your retirement, and you are basically, or you are, depending on the pension. Your risk appetite is lower. You don't want to dabble into very risky investments, and your investment duration is short. So for such kind of an investor, the best investment strategy is a debt strategy, where 70% of the investment typically can be in debt, 20% into equity, and 10% in commodity like gold. On the other extreme, we are talking about an investor who has a very high financial security. He's young, he or she is young in age, has a high risk appetite, and looking at a higher investment duration. For such kind of an investor, can look at very aggressive investment. You can go up to as high as 70-75% in equities, a bit of debt to shield from the vagaries of equity, and again 10% in commodity like gold. Now, anything between the 2 extremes will fall into either moderately conservative, moderately aggressive, or moderate. Point being that in all the allocations, you will see that we have added commodity, which we very strongly feel should be a part of investors' portfolio, which should be about 10%. Depending on one's need, it can even go up. But when we talk about commodity, we are not asking investors to go and buy physical gold. Today, there are various options available where investor can invest through, financially through ETFs, etc., or through index funds, FOFs, in the products like gold or silver, right? Because those have their own merits and are cheaper, and at the same time, give you a lot of peace of mind in terms of returns, and also in terms of the storage costs, etc., which has the cost, etc., which need not to be borne in case you're investing in those funds. So finally, this is one heat map which I'm not very sure how much clear would this be, but just look at the colors here, and what we have done is we have masked the name of the funds here. We didn't want it to become very, very objective like that. So idea is to show you there is no single color that has dominated. Obviously, this data is dated. It is not updated. However, the point here is that none of the single color is dominating. The 7-8 year data that we have shown you here. So you have seen 4 blacks on the top, but then black almost disappeared in 2021, 22, and 23. Similarly, you would have seen a dark red in March 20, but that dark red was nowhere to be seen in 17 or 18. So This is a large cap scheme performance heat map. And as you can see, there is none of the single fund is able to remain on top for year on year. And since all of these are large cap schemes, so therefore all of these schemes, there will be active fund managers involved. So again, a better alternative would be, to invest in an index fund, say in a large cap category, and forget about it. As we saw, is passive investing boring? It is not. But if it were boring, I think it is. It is good that investor doesn't even have to look at his investments back, and they can just need to trust the index and let the investments prosper. This is all that I had to share. I've taken almost about 41 minutes. So we can now open the session for any question and answers, and would be more than glad to take any queries that you might have. Over to you, Angelica.
So this website was truly insightful. I'm sure we've all learned something about asset allocation with index funds and how it can be beneficial. Before we conclude, I'd like to open the floor for any questions from the audience. We have a question from Siddharth Malik. So, why index fund manager puts small portion of money in Nifty?
Siddharth, I'm not sure. See, as an index funds are mandated to be always invested in the portfolio. So that is the mandate given to the dealer when he gets the money. Since there is no directional call here, as soon as the money is received, it is supposed to get invested. However, on some instances, it might so happen that you have a corporate action that is announced today, and you have received the benefits of that corporate action in the portfolio after the market closure time. So on that particular day, it might so happen that instead of that money lying idle in the index fund account, the fund manager might invest in a one-day repo or a one-day TREPS, so that the investors get return from that particular corporate action or dividend that has happened. Otherwise, if the fund manager or the dealer gets money, there is no reason for that money to lie in any kind of a repo or a TREPS. It has always to be invested.
Do you have any more questions from the audience? We're open to answering them. Should we conclude, sir?
Sure, if there are no questions, we can conclude the call. Yeah.
Yes, I think that's it. We had one question. Thank you, sir, for your insights on the fund. We surely found this session insightful and knowledgeable, and I hope the audience liked it as much as we did. Your expertise and passion for this subject were evident throughout your talk, and we appreciate you taking the time and to share insights with the audience as well. Thank you very much.
Thank you very much, Angelika. And on behalf of SBI Securities, I thank everyone for joining in, and thanks for giving us this opportunity to come and present this topic to you.
Thank you.
Thank you very much.